Thank you for viewing this presentation entitled Viability, Liability, and Retirability: How an Employee's Ability to Retire Impacts Your Company's Bottom Line and Long-Term Future. I am Janelle Cross, President of Align Financial Services Group. We are retirement plan specialists with over 35 years' experience helping organizations design programs that are legally compliant, operationally efficient, and properly utilized by the workforce. Every aspect of our service is centered on our determination to create successful outcomes for employers and employees alike. I hope this brief video will demonstrate what we think really matters when it comes to your 401k and how an underutilized plan can cost employees and employers alike. The past 35 years have brought dramatic change in retirement funding. As company-funded pension plans are replaced by voluntary employee savings plans, the liability to save has transitioned from organization to individual. And although most employers make some kind of company contribution, today's corporate liability to ensure employee retirement security appears to be much smaller than it was in the pension days of yesteryear. But what have employees done with their responsibility to save? There are endless, dire statistics about the nation's lack of retirement savings. The reality is that many workers simply can't afford to retire. As they keep working, they shift liability back to their employer in the form of higher wages and higher insurance costs. These financially trapped employees are also less productive, less committed, and more likely to be absent. It is important to note that this is not an age issue. A fully engaged employee is well worth the marginal difference in cost. We're talking instead about the financially trapped employees and how can we work toward giving them the freedom to decide whether they work or don't work. Let's dive deeper into the costs of retaining a financially trapped worker. This is a real-life case study of a manufacturer with 360 employees. Using their census data, we calculated the average wage for an employee who is older than today's typical retiree. We compared the costs of that 64-year-old worker to a qualified replacement worker age 37. The wage and healthcare cost differences are shown here. Each worker who delays retirement costs this company about $14,000 per year. Across the entire 360 employee population, we estimate that 41 out of 50 retirement-age workers will delay retirement based on their current 401k account balances and deferred savings rates. That comes at a cost of almost $216,000 per year in higher wages and insurance premiums. And if this trend continues, over the next 5 years, delayed retirements could cost this company over $1.6 million. A number that looks a lot like yesterday's pension funding liability. The good news is that we can do something to change this. By dedicating time and resources to actions that are proven to have the greatest impact on participant outcomes, Align Financial Services Group can help your employees get back on track and moving toward a dignified and timely retirement. From managing fees and investments to satisfying fiduciary duties, your company's retirement plan committee has a lot on its plate. And thanks to increasing regulation from the Department of Labor, running a retirement plan has become quite complex. Fortunately, most hired advisors and their committees have addressed their responsibility to construct a quality program. Like our competitors, we ensure that your fund performance measures up and that your fees are benchmarked regularly. Also, like most retirement plan consultants, we serve as a co-fiduciary to your committee. By putting our legal skin in the game, your fiduciary compliance isn't just our desire, it's our duty. Finally, because we're independent of proprietary products, you can rest assured that our recommendations are free from conflicts of interest. With fees, funds, and fiduciary duty addressed, most plan sponsors, and many plan advisors, would deem your program a success. But at Align, we believe there's more to the story. If your company's goal is to remain viable long into the future, we need to change the definition of retirement plan success. Good funds and low fees are essential, but the mark of a truly successful plan is reflected in participant outcomes. In other words, are your employees building meaningful retirement savings accounts within your program? No matter how well designed your plan is, it doesn't help your company or your employees if participants aren't moving progressively forward in pursuit of retirement readiness. Motivating and helping employees make better financial choices isn't just what we do best at Align, it's what matters most when it comes to improving outcomes in your plan. I'll explain why this belief is at the center of everything we do. There are lots of different pieces you can adjust in your retirement plan. You can change the various mechanics of your plan, or you can change the behavior of participants. Obviously, changing mechanics is a much easier task, but the impact of ideal plan design and impeccable fund selection pale in comparison to the benefits of improving participant behavior. Consider these results from an ongoing study, currently in its 31st year, from Empower Institute called Missing the Forest for the Trees. Researchers examined the impact of changing different variables, including investment selection, asset allocation, portfolio rebalancing, and increasing participant deferrals. The results may surprise you. Researchers examined 5 different methods for selecting plan investments, including a strategy where the employer had a crystal ball and made perfect investment selections with foresight. In other words, they predicted winners and losers ahead of time and made adjustments accordingly. They found that regardless of strategy, however, investment performance generated roughly the same amount of wealth for the participant. Next, they looked at rebalancing. While rebalancing produced less retirement wealth, it also reduced volatility. Producing steadier returns with less fluctuation may help participants stick to their plan, especially in challenging markets. But in this study, rebalancing did not materially benefit the participants' outcome. Next, they examined asset allocation. By increasing the equity allocation of a conservative portfolio, they found that investment results increased with a corresponding increase in volatility. This emphasizes the importance of investment education for participants. While some investors are risk-averse and are most appropriately invested in a conservative portfolio, many participants default into conservative investments simply because they don't understand or are intimidated by investing. Also, until recently, many plans had a guaranteed account or a money market as the default election for participants who didn't provide alternative investment instructions. Finally, researchers examined the impact of increasing participant deferral rates. They found that the incremental impact of higher deferral rates can be one of the most significant drivers of long-term returns. When the contributions were dialed up from 3% to 10% over 31 years, the ending portfolio value jumped from $205,000 to $503,000. Interestingly, even a 1% increase in the participant's contribution would have had a wealth accumulation impact 3 times larger than if the employer had made crystal ball perfect investment selections with foresight. If you'd like information on this study, please give us a call. We'd be happy to answer any questions or go over the results with you. The study validates what we already know. Managing behavior is the key to investment success. But how much time does your committee spend discussing fees, funds, and fiduciary versus participant behavior? I certainly don't want to minimize the importance of meeting the basic and essential requirements of operating a retirement plan. Your committee should meet at least annually. You should document your processes using an investment policy statement. Under fee disclosure regulations, you need to understand all of the various fees associated with your plan, and according to the Department of Labor, you should be benchmarking those fees every 2 to 3 years. And finally, under the new conflict of interest rule, which takes effect in April 2017, you must understand precisely the fiduciary status of your hired providers. With reasonable fees, good funds, and fiduciary compliance in check, most plan sponsors would be happy with their program and unlikely to look much further into whether or not the plan is actually helping employees get better prepared for a timely and dignified retirement. But if the overall goal of your organization is to remain profitable and therefore viable long into the future, then you can't stop at fees, funds, and fiduciary when it comes to evaluating the success of your program. No matter how well designed your plan is, it doesn't help your company or your employees if participants aren't moving progressively forward in pursuit of retirement readiness. I hope we've demonstrated that the liability to prepare for retirement is shared by both employees and employers. And although this liability isn't explicitly disclosed on company financial statements, employing financially trapped workers most certainly has a negative impact on the long-term viability of any organization. While it is essential that committees uphold all of their fiduciary duties, the success of a plan must be measured by participant outcomes, not just good funds and low fees. Improving outcomes means ensuring that you've taken full advantage of plan features designed to increase participant account balances. However, it's not the option you use, it's how you use it. Because when it's all said and done, the success of your plan will be most influenced by the educational efforts of your hired advisors. The benefits of perfect fund selection and low fees pale in comparison to the impact of positive changes in participant behavior. Your company's retirement program is a vital component of building security for your organization and your employees. Between progressive plan design and a robust, effective employee education program, Align Financial Services Group can help employees prepare to retire with dignity, a more viable solution for both workers and organizations. I hope you found something of value in this brief presentation. We invite you to call, email, or visit our website to keep the conversation going. Outcomes matter most. We'd like to make it our duty to drive successful outcomes within your organization. Thanks for listening.